Dr. Yellen, thank you very much for being with us. I would urge you to search YouTube and put in Jimmy Stewart Wonderful Life. The very first 2-minute clip is an exchange between George Bailey and Mr. Potter that captures so much of what we're talking about here today. And I would just say, gosh, Ms. Yellen, gee whiz, we would, channeling Jimmy Stewart, how about putting a community banker on the Federal Reserve Board? Don't you think that would be a good idea?
I'm in favor of that. I certainly am in favor of that. We just lost 2 individuals who are very familiar with community banking. Governor Duke, who ran a community bank in Virginia and had a lifetime of experience in community banking, and Governor Raskin, who's now moved to become Deputy Treasury Secretary, who served as Commissioner of Banking in Maryland and got to know the community banks and the community bank regulatory issues very closely. They made huge contributions, and I would love to see a replacement.
I hope you'll convey that sentiment to the White House, please.
I've done so. Thank you.
By the way, I met with a group of bankers from Maine just to underscore the point you made earlier about a little weakening in the housing market. That's what I was hearing from them. They're seeing a marked decline in new mortgages, and I realized the plural of anecdote is not data, but it's getting close, and I think that is something we need to pay attention to. I was at a panel recently on economics, and there were 2 questions that were unrelated to each other, but it seems to me they are related. One was about why is this recession recovery so sluggish, and the other was about the gross income inequality. The data of 95% of the income growth in the last few years has gone to the top 1% of the population. Seems to me those 2 things fit together. If 2/3 of the American economy is driven by consumer spending, and the income is going to the top 1% and not to the people who do the spending, isn't that a contributing factor itself to the sluggishness of the economic recovery? Well, the lack of demand.
Well, I mean, we have been trying to stimulate demand. Greater spending is the key to trying to get the economy to operate.
But what I'm saying is the consumers who generally drive the economy aren't getting the income growth.
So that clearly is a factor that is relevant to the pace of expansion we have seen, yes.
And the famous book that was just recently come out, Mr. Piketty, talks about the drag worldwide by income inequality. Have you had time to digest that? It's only 1,000 pages.
I can't say I've gotten to the last page of it, but I'm certainly familiar with the book. And
well, it just seems to me as something, again, going back to the basic principle that 2/3 of our economy is driven by consumer spending. Henry Ford, 100 years ago this year, had this insight, doubled the pay of his workers so they could buy his cars, and we've got to start thinking that way again.
Well, many economists have argued that the distribution of income does matter to the pace of spending, and you know, I don't know of any utterly clear evidence on this topic, but it makes sense to assume that households that would tend to spend a great deal of their income when income distribution shifts in the direction of those who are wealthier and likely spend at the margin less of their income, that creates a drag on the economy. And a number of economists have certainly made that argument.
In about a 1 minute left, I want to turn completely and talk about the issue of debt, which several of your questions have talked about. I think you've articulated an intelligent strategy, which is be careful about short-term, abrupt fiscal changes to deal with the debt, because that, in effect, as you characterize, is a headwind for the recovery.
Right.
On the other hand, we can't ignore this. I mean, the debt, just the interest on the debt, if we have a 1% increase in the interest we're paying on our current federal debt, 1%, which I think everyone agrees is likely within the foreseeable future, that will suck more money out of the federal budget than the sequester.
So I would agree that interest does matter to spending and to the accumulation of debt. I would also want to point out, though, that interest rates are unlikely to begin rising until we are in a strong economic recovery. So we eventually will start to raise interest rates. I mean, I'm assuming the economy will continue to recover, and at some point that will become appropriate. But in thinking about what will happen with deficits and the debt, it's important to keep in mind that a stronger economy will be very good for the federal budget deficit. There will be stronger revenues coming in and a decline in social safety net spending, and that will be an offset and probably the most important element for the deficit and the evolution of the debt. Yes, interest payments will go up, but I believe the larger piece of it is likely to be that a stronger economy will improve the budget. So both of those things are operative.
So a long-term strategy, not a short-term emergency strategy, is what we really need to be looking at.
That's what I would urge.
Thank you.
Thank you.
Madam Chair.